All right. Hello, everybody. This is Mike Rixey. I'm the lead options instructor for NetPIcks, and this is our weekly options recap. In today's session, I want to highlight where we're at going into next week. We do have a holiday shortened week next week, which I'll talk about in just a moment. I want to talk through some key markets that we are tracking for next week. I'll walk you through some trades that we've closed out here this week. We've had a really nice week with our overnight pop trades. Just continues to be a really great performer for us. So I'll walk you through how we utilize that trade, what to expect from that type of a setup, how we take and manage it, and so forth. As always, if you have any questions throughout the live session today, feel free to type those into the chat anytime, and I will get to those as soon as I can. If you are reviewing the recording, if you're watching this over the weekend, feel free to post a comment here inside of Facebook or YouTube, or you can email me directly. Mike@netpicks.com is the email address. So what I'd like to do with all of these sessions is I like to start out by walking through some general thoughts on the overall market. This is crucial because it helps shape what types of strategies I'm looking for. It's really easy to come in and want to be 100% aggressive all the time, short-term weekly options. The problem with that approach is markets change. Markets will fluctuate. Markets will cycle. And I think we're starting to see a late stage move. I think we've seen it here this week, and we're starting to see a reversal develop that could lead to some better two-way price action going into next week. Now, next week is a holiday shortened week. We do have markets closed on Monday, so keep that in mind. With that being the case, a lot of times going into a holiday shortened weekend, I shift my focus more towards the credit spread side of things, just to get the time decay working in our favor. You can put on a long option position today. Just because markets are closed on Monday does not mean the time decay pauses. The time decay is still there over the weekend. So I don't want to get caught with a lot of long options going into the long weekend. If you've already got positions on, if you've already put on positions this week, that's fine. You can continue to hold those long options through the weekend. I just don't want to initiate any new long options here the afternoon before a long holiday weekend. I'd rather wait until Tuesday of next week to do that. Let me actually zoom in here. Take my face off of the screen. So let's talk through some technical levels as well. Actually, before we do that, let's talk about earnings season as well. Earnings season officially kicked off this morning with a lot of the with a lot of the financial names releasing their earnings. We had JP Morgan, we had Citigroup out. We've got a couple of the financial names out with earnings on Tuesday next week. So I want to keep that in mind. Going through to the end of the month, a lot of the names on our list, a lot of the tech names towards the end of the month will be releasing their quarterly earnings. The reason I point that out, when we start to get into earnings season, it's very common to get some of those overnight gaps. You get the earnings to come out, markets will react to those earnings numbers, and you can lead to some pretty impressive gaps higher or lower. I'm not saying you shouldn't trade through earnings. You just want to be cautious in doing so. I do not like to hold positions in my own personal trading. I don't like to hold positions on individual stocks through an earnings number. You take Citigroup or JP Morgan, for example. We knew earnings were out this morning, so I made sure I was closed out of any open position that I had on either one of those names yesterday afternoon. I just don't want to get caught on the wrong side of a big earnings gap. Sure, they can work in your favor from time to time, but more often than not, it's going to lead to some painful losses. And those losses can happen in a hurry if you're on the wrong side of an earnings related move. One of the tools that I use, if you're wondering, how do I know when the earnings are coming up? One of the sites that I have used over the past number of years is earningswhispers.com. I just use the free portion of this site. Up at the top of the site, there is a ticker box. And if you type in any symbol, just type in Apple, it will pop up the earnings date. So you can see Apple has earnings out on January 27th after the market closes. It'll also give you the whisper numbers. It'll give you the expected earnings numbers, what's being priced in. I don't do anything with that. All I'm looking for here is when are the earnings coming up? And I go through my entire watch list and document when those upcoming earnings releases are. So that way I can avoid them if at all possible. If you're a Thinkorswim user, over on the left-hand side, you most likely have a watch list set up. You can also utilize the watch list here. If you click on the red or blue icons next to those symbols, you'll see here that the earnings date for Apple pops up January 27th. So you can find the earnings dates there as well. probably a worthwhile approach over the weekend or early next week, just to go through your entire list, document when those earnings come out on each individual stock. That way you don't get surprised by one of those overnight or pre-market releases that come out. From a technical perspective, coming into this week, we were very overbought. Markets have been on an absolute tear to the upside, really showing their approval of the new president ready to take over, President Biden. Also cheering the rumored, up until the last 24 hours, rumored next round of stimulus. Now, the stimulus plan was announced, wasn't anything unexpected. Central banks, the Fed, I mean, they're going to continue to throw as much money at the system as possible, just with all of the unknowns with COVID. Well, you've got this market now that is pricing in an incredible amount of good news. We were at all-time highs coming into this week. We've pulled off of those highs here the last couple of days, but we're still very overbought big picture. It does not mean the market can't head higher. It just means we're very overdue for a pause. We're overdue for some healthy selling. Our all-time high on SPY is up at 381.49. That is our level to watch on the upside. Should we reverse back to the upside going into next week? That's the level that needs to break. Should it break? Next areas of resistance above that level, since there's no previous swing highs to consider above that level, we're looking at the big round numbers, the big 0.50 level. So 382, 382.50, 383. Those are going to be levels that we will want to watch going into next week. On the downside, we did get some support right on the lows of the session. We got some support right on top of the 20 period moving averages, both the simple and the exponential. Those levels have been rock solid. I mean, for months now, going back into last year even. I mean, you can take a look at the past 4 or 5 situations where we have tested those levels. We have bounced off of those levels, and we've seen moves up to the highs off of those levels. So that's the level that we need to break if we're going to get anything going on the downside. Should those levels break, we do have an air pocket between the 20 period moving averages and the 50 period moving averages down below. So should we break that level going into next week, we could see a very quick pop to the downside. The volume, my concern here on this latest round to the upside, you can see that the volume down at the bottom has continued to contract. Okay, when you start to see volume contract like that to the point where it's been a struggle to hit 50 million shares traded on SPY, it typically means it's a late stage move. Everybody that wants to be bullish is already bullish. They're already in those long trades. Not really an attractive level here to initiate new bullish trades, but it's also not an environment that you want to get ultra aggressive on the downside because every dip continues to be bought. As a result, we're in this low volume environment. In order for that volume to pick up, we absolutely need to see some selling going into next week. If we continue to see markets plow their way to all-time highs, we're going to continue to see volume contract. Now, volume is at a good number today. We're at 56 million shares so far today. A little bit misleading because we do have monthly options expiration today, this afternoon. We'll typically have very good volume on those expiration days. So a better test of the volume picture would be next week. Once we come back after the holiday, once we come back on Tuesday, can we continue to see the volume pick up? That's going to be much needed if we are to see any type of back and forth movement from kicking in. Let's talk about some of the individual trades that we closed out here. Closed out of these trades this morning. So the overnight pop trades I mentioned, they continue to be really good performers for us. When we take a look at this market, I mean, it's very, very overbought. Okay, now it doesn't mean I want to get ultra aggressive on the downside and just come in and buy long puts. The problem with that approach is if we don't have the follow through, if you don't get any type of follow through into day 2, 3, 4, it's going to be difficult to get any type of traction on those options. I continue to favor the credit spreads because they tend to be more forgiving type trades. I can put on neutral to bearish positions that would benefit from a market pullback, and I can do so with a higher probability trade. Let me show you what I'm talking about. Let's go over to IWM, and I'm going to take a look at the 195-minute chart. So give me a quick second to pull this up. It's our desired time frame. We love to use this time frame. It gives us 2 candles a day instead of 1, so it just speeds up that daily chart. It tends to be a really good sweet spot for us. We find that it eliminates some of the noise that can kick in from some of the shorter term timeframes. And it also allows us to, sorry guys, trying to turn some alerts off. I see this market is moving here as I'm speaking. So on my trading computer, I've got alerts. It's been a busy day for alerts. I've had them go off all day. So I'm trying to turn those off. So the 195-minute chart, it prevents us from getting caught up in the noise, and it allows us to identify some of those longer term moves. We can see that price action is very overbought. Okay, we're very extended from all the moving averages. Our indicators down at the bottom are reaching overbought conditions as well. So what we did yesterday afternoon is we said, okay, markets are incredibly overbought. We're at all-time highs on IWM. We're going to go ahead and sell a call spread. Now, the overnight pop trade, as the name implies, we're looking to put on trades going into options expiration. We're looking to get in and out within 24 hours or less. We're looking to hold overnight, close the trades out right away as soon as possible on expiration day. So what we did here yesterday afternoon, and bring back up the trade page, we sent this alert out to our members. We typically send the alerts out in the last hour of the trading day. So we sent this one out Thursday afternoon. We came in and we decided to sell the 216-218 call spread. So I'm going to right click on the 216 call, go to sell and go to vertical and pop up that order down at the bottom. All we were doing is selling the 216 call and buying the 218 call at the same time. Now we sold the spread for 52 cents. We collected $52 per spread to put this position on. It only tied up $148 of our capital to begin with. Very reasonable trade regardless of account size. These are very liquid products as well. If you've got a bigger account size, you can put this thing on 10, 20, 30 times. You put it on 10 times and you still had less than $1,500 of risk. Now, we made money on this trade as long as IWM stayed below 216. That was the strike price of the option that we sold. I don't care if it stayed below that level by a penny. If the stock moved up, down, or sideways, it did not matter to me as long as price stayed below 216. We also made money from time decay adding up, which when you get that close to expiration, time decay is extreme. We also made money if volatility decreased. We had 5 different routes to follow to make money on this position. We ended up closing out of the trade first thing this morning, right after the opening bell. Within the first 5 minutes, we were able to close out of this position. We actually closed out. You can see it's trading for 2 cents here. We closed it out for 7 cents this morning. It gave us a $45 profit per spread. Again, I'm only tying up $140 to begin with of capital. So it was a 30% return on our capital, and we're in and out in less than 24 hours. We opened the trade around 3:30 p.m. Eastern time yesterday afternoon. We closed out of the trade about 9:35 Eastern this morning. Very quick trade. We had 5 different ways of making money on the position. It gave us a high probability of success. And these are the types of trades that help generate some consistent income for me on a weekly basis. We have multiple opportunities for these overnight pop trades each week. SPY, which is the S&P 500 ETF, actually has expiration cycles every Monday, Wednesday, Friday. We actually have 3 opportunities for overnight pop trades on SPY. And then all other stocks and ETFs have options expiring on Friday. So we can take these trades Thursday afternoon into Friday. So really great trade for us. Book the profit, very low stress trade. Even if we were dead wrong, I get this question quite a bit. What if the stock moved against us? What if it continued to move higher? The most I could have lost on this trade was going to be $148 per spread if I was dead wrong. All right. Now, another one that we put on yesterday afternoon, Plug Power is another one that is incredibly overbought. Let me see if I can load up the chart here. I know my platforms, or anytime that I show my screen here, it zaps my bandwidth. So it'll take a few moments to load up. But what we're going to do is look at this chart on the 195-minute time frame again, and you will see that price action incredibly overbought. Some of these, some of the solar names, some of these, some of the electric vehicle names. I mean, it's just been an incredible area. Some of these alternative power sources companies have just been on fire. Very, very overbought on Plug Power. I mean, hard to ignore this type of a pattern. I mean, basically over the last couple of weeks, we have gone from 30 all the way up over almost to 75, more than double just over the past couple of weeks. Well, what we did yesterday afternoon, we started to see price action pull back. We started to see things roll over a bit to the downside. Could we have come in and bought a long put? Sure. But that's an ultra aggressive route to go. I didn't want to be that aggressive on the downside. I wanted to be a little bit more conservative. So what we did on Plug Power is we came in and we sold a call spread, utilizing the options that expire here today. We put this trade on again around 3:30 p.m. Eastern time yesterday afternoon. And we came in and we sold the 68.70 call spread, meaning I was selling to open the 68 call and I was buying to open the 70 call. We collected 60 cents or $60 per spread on this trade. It tied up $140 of our capital. Very similar trade profile to the IWM trade that we just talked about a few moments ago. We ended up closing out of this trade. You can see it's priced for 6 cents currently. We actually closed it out earlier today for 15 cents. That gave us a $45 profit per spread, a 30% return on our capital overnight. Okay, so we had 2 overnight trades here coming into this morning that were closed out within the first 5 minutes of the trading day. I love this type of trade. When you start to put these on, I'm not saying you should ignore the long calls and long puts. I'm not saying you should ignore some of those longer term positions. But when you start to add this into the equation, the overnight pop trades can provide a really nice way of diversifying. A lot of us, let's face it, a lot of us like the excitement. We like the instant gratification. And this trade provides that for us. Doesn't mean that we're going to win on every trade. We actually have 7 winners in a row now over the past couple of weeks. So it can be a really high probability success type of a trade because we've got 5 ways of making money on the position. Both of those trades were bearish positions. They made money because the market is lower. Do we have to be directional on these trades? Do I have to pick a bullish or a bearish move? We don't. We actually took one more trade. And we did this one on the SPY. This one was actually an iron condor. Now, a lot of times people get intimidated by the term iron condor. They think it's an advanced trade. They think it comes with a lot of risk. It's actually not. All I'm doing here with an iron condor is I'm selling an out of the money call spread and an out of the money put spread at the same time. All right. What it does is it creates what's called a profit window. I'm selling the 381 call and I'm also selling the 375 put as part of this trade. That defines my profit window. I just want price to stay between 375 and 381. As long as it does, I don't care if we move higher, lower, sideways, doesn't matter. As long as we stay between those 2 levels, we get to make money. Now, we've actually seen moves higher and lower today. Didn't matter. Bottom line is price has stayed between those 2 strike prices. We actually sold this spread yesterday afternoon, again, right around 3:30, between 3:15 and 3:30 Eastern time is when we typically put on these positions. So I'm trying to pull up my fill price here and make sure I get you the right one. So we sold the spread yesterday afternoon for 60 cents. We collected $60 per spread. It tied up $140 of our capital. Again, a lot of these trades, we're talking about $150 or less in some cases. So just a really good use of your capital regardless of your account size. We actually closed the trade out. It's currently priced for around 18 cents. We closed it out earlier for 20 cents. It gave us a $40 profit per spread. And the beauty here is, let's just go ahead and pull up that 5-minute chart again. Let me just pull it up a second. The beauty here is we've had some pretty decent movement in both directions. I'm going to pull up a 5-minute chart of SPY. We started out with a pretty big move to the downside. The first hour of the session, it was some pretty nasty selling, some of the worst selling that we've seen in weeks. We then followed it up with a buy the dip right around 10:30. We saw that 10:30 reversal, and we basically have spent the last few hours moving our way to the upside. We've seen big moves in both directions, and in the end, our iron condor is still making money. We were able to book a really nice profit on that spread. Again, all we have to do is hold overnight. We're booking profit. Are these going to be record-breaking profits? No, a lot of these trades are going to be looking at 30, 35% returns on our capital. But it adds up. It adds up in a big way. We've actually had 26 wins and 3 losses in the last 29 trades that we've taken with the overnight pops. on our ETF program. So they just continue to perform really well for us. It provides that consistent source of income for us. And it takes the pressure off needing those big directional moves in our favor. I know some of you like to buy the long calls, long puts. I do too at times. That's a big part of what I do. But we also know that in order for those trades to work, we have to have big market moves. Those aren't always going to happen. We've been spoiled here for the last number of months with big moves in a lot of these stocks. Going forward in the months to come, it's very possible that we do start to see some chop kick in. We do start to see some indecisive markets. And you want to have some of these other strategies to go to create those consistent returns, regardless of what the market does. The overnight pop trades, they fill that spot on our watch list really well. Fernando asking, will it be a sell-off next week? Well, so the market is incredibly overbought. We've already talked about that. I'm going to pull up some of the 195-minute charts here in just a second. If we just pulled it up here, so let me get this text off of the screen so you can see it. I do think we're near the tail end of this move on the upside. I don't expect the market to crash. I'm not saying it's going to do that, but I think we're very due for some healthy movement to the downside. I think it's going to be a very tradable move to the downside. Where would I potentially be looking at as far as a move lower? The daily chart that we looked at earlier, that's one that I just used to put overall context around the overall market. The 195-minute chart is actually the one that I use to trade off of. Now, there's a couple things that I am looking at before I take a look at buying a long put. Our trend strength histogram down at the bottom, you can see that it's still hanging on to a blue reading. It's currently sitting at 0.32. If we see that break down below the zero line, okay, that would indicate bearish momentum taking over. We've already started to see price action roll over here over the past 24 hours, but it hasn't confirmed the move yet. So I need to wait for a trend strength histogram reading below zero in order for me to buy some long puts. I definitely think that's on the radar for next week. It's something that I am expecting next week, but we'll just have to wait and see what happens. Again, this market is very resilient. I mean, they're talking about throwing another $2 trillion as a stimulus plan, to try to prevent any type of weakness from kicking in. So it's going to be a challenge to get any type of significant selling from kicking in. But just from a pure technical perspective, this market is indeed very overdone. So yes, I am expecting some weakness going into next week. So SPY, again, the potential is there for a short trade. Not doing anything as of yet. Definitely need to wait for price action to confirm first. The NASDAQ ETF, QQQ, I mentioned that we are going to be going into earnings season over the next couple of weeks. The tech names are really more so towards the end of the month. Apple, Amazon on the 27th and 28th of the month. So we do have a little bit of a window to sneak some additional trades in. The NASDAQ ETF, QQQ here, this is a name that I will continue to trade right through earnings season. So this is another one very overbought, very overdone on the upside, but our trend strength histogram down at the bottom has not flipped below the zero line yet. You can see in the lower right corner, we're currently sitting at 0.2. I need to see that flip over to the red side. It needs to flip below the zero line. So nothing for me to do as of yet, but this one is also on my radar for next week. So let's actually talk about some charts that have setups that are printing for us for next week. Let's go back to that chart of Plug Power. I mentioned that it was one of the overnight trades that we took here yesterday afternoon into this morning. It's also given us an opportunity for a longer duration trade. In most cases, the overnight pop trades are great, but in most cases, we're looking for holding times anywhere from 3 to 30 days. That's what we classify as a swing trade. Well, we can see down at the bottom, our pulse histogram. It's this yellow, green, and blue histogram down at the bottom. What do those colors mean? It means that we're at an overbought extreme. The yellow bars mean that price is between a 1 and a 2 standard deviation move on the upside. The green bars represent price being between a 2 and a 3 standard deviation move on the upside. And that one blue bar there indicated that price earlier this week got between a 3 and a 4 standard deviation move on the upside. That does not mean price can't move higher. It just means it's not statistically probable. Less than 1% of all occurrences are going to fall outside of this range on the upside. In other words, we are due for a pause. We're due for a pullback. We have already started to see that. That's a very typical pattern. It doesn't have to turn on a dime. When you get these extremes on the pulse, it doesn't mean it has to turn the very next day, but you can see that within a week, now we're starting to see price action reverse. We're actually starting to break that red and blue line up at the top. That's our 8-period exponential moving average. My read on this, I would rather lean neutral to bearish in the near term, looking for a further pullback. We're already down 7% here today. So prices already started to reverse. I don't want to just buy a long put here because coming off of a big move, it's very typical to see the initial wave to the downside, which we've had last 24 hours or so. It's very common to now start to see some chop kick in. I would rather put on a credit spread to put the time decay in my favor. That way we can navigate through some of that choppiness if it kicks in. So here's what I'm looking at. Let's go over to the trade page. And let's switch the symbol to plug. PLUG. And we're going to go out to the February monthly options. Those are the options with 35 days left to expiration. We're going to go to the out of the money calls. And I'm going to go to the 70 call. Okay, it's about between $7 and $8 out of the money. I'm going to right click on the 70 call. I'm going to go to sell and I'm going to select vertical. That is going to pop up an order down at the bottom where I would be selling the 70 call and buying the 75 call at the same time. There's a $5 difference between those strikes. I typically like to collect between 30 and 40% of the width of those strikes. In this case here, because there's a $5 difference between the strikes, I want to collect between $1.50 and $2. The current spread that we're looking at here on the screen is only pricing at $1.30. It's a little bit light. It's not quite at that $1.50 level that I'd like to look at as a minimum. So let's go ahead and make a small adjustment here. Let's go ahead and move the 70 call to the 65 call and the 75 call to the 70 call. All I'm doing is moving those options closer to the current stock price. Now, you can see this trading for $1.65. That meets my minimum criteria. Why do I want to look for $1.50, between $1.50 and $2? Because it helps me manage my reward to risk ratio. I don't want to risk 5, 6 to make 1. I can't make that work. If I risk 2 to make 1, I absolutely can make those numbers work over time. So if we get filled at $1.65, let's just go ahead and take a look at this trade. I would be risking $335 per spread to make $165, right around risk 2 right around risk 2 to make 1, give or take a few bucks. I'm okay with that ratio because I've got 5 ways of making money on this position. I make money if the stock moves up, down, or sideways. It does not matter as long as price stays below 66.65. The current price is at 62.5. I've got about a $4 cushion where this thing can move against me directionally, and I'm still okay. Ideally, I want the stock to move lower. I'm going to make money the fastest if the stock moves lower. But if we just move sideways, even if we move slightly higher from here, maybe we're dead wrong and we continue to drift higher. I make money as long as price stays below 66.65. I also make money as time decay adds up. Every day that passes, that helps me. And I make money if volatility decreases. I've got 5 different ways to make money over the next 35 days. The only move that hurts me is a big move higher from here, which we're not expecting because price is already so overbought. So that is a trade that is certainly valid for next week. How would I manage the trade? Let's talk about that briefly. Let's say that we get filled at $1.65. The only way that I can keep the entire $1.65 is if I hold all the way up to expiration. That is not something that I want to do. I typically want to close it out before expiration, and I am targeting between 50 and 75% of my max profit. My max profit is the $1.65 that I'm collecting here to put the trade on. Ideally, I would like to close this thing out between 41 and 82 cents. If I can close it out between that range, it allows me to keep between 50 and 75% of my max profit. So I'm going to start my closing order, looking to close this thing out for 41 cents. That would allow me to hit my target zone. Now, another name on the list for next week is XLE. This is the energy ETF. Another one that's very, very overbought. We have seen yellow and green bars on the pulse indicator down at the bottom. Prices between a 2 and a 3 standard deviation move on the upside. Again, doesn't mean that price can't head higher from here. It just means it's not statistically probable. Odds favor either a period of consolidation or a reversal to the downside. Look what's happened here over the last 24 hours. It hasn't been a huge move lower, but we have seen this thing start to roll over a bit. Very typical of this type of a chart pattern. Now, this is another one that I'm going to take a look at selling and out of the money call spread because I want to have a higher probability of success. I want to have multiple ways of making money on the trade. Not willing to get ultra aggressive here with long puts. So let's go over to our Thinkorswim platform again, and I'm going to switch the symbol to XLE. We are going to continue to take a look at the out of the money calls, and I'm going to take a look at selling the 45 call. I'm going to right click on that, go to sell, and go to vertical. I want to sell the 45 call, and I'm going to take a look at buying the 47 call at the same time. There's a $2 difference between those strike prices. I want to collect between 30 and 40% ideally of the width of the strikes. I want to collect 60 cents at a minimum. This trade is currently pricing at 55 cents. So we're close. What I could do is just bump the price up to 60 cents. I wouldn't get filled immediately. I'd need a little bit of a rally to get filled at 60 cents. But let's just say we can get filled at 60 cents this afternoon or even Tuesday of next week. What this trade means here, if I'm selling the 45 call and buying the 47 call, it's a neutral to bearish position. Ideally, I make money the fastest if XLE moves lower. As long as price stays below 45, I get to make money. 45.60 to be exact. That's my 45.60 is my break even. As long as price stays below 45.60, I get to make money. I am risking $140 here to make 60. We're right between risk 2 and 3 to make 1. That's a very typical range for us. Not tying up a ton of capital, which is really nice. That's another great feature of the credit spreads. It's just a better use of our capital. We make money if the stock moves up, down, or sideways, so we're okay in all 3 directional moves. The only move that hurts me is a big move above 45.60, which we're not expecting because price is already extremely overbought. Even if we're dead wrong, we've got about a $2.50 cushion. This thing could move to the upside, and we're still okay. We also make money from time decay adding up and from volatility decreasing. All right. So how do I manage the trade? If I put this trade on just like plug power, if I collect 60 cents per spread, that's my max profit. I'm ideally looking to close this thing out when I can buy it back and keep between 50 and 75% of the max profit. So if I can buy this thing back for between 15 and 30 cents anytime over the next 35 days, I'm going to go ahead and close it out and book the profit. Okay, so these are trades that, a lot of times, and especially in this market, I continue to get emails from people that, they're looking for those 500% winners, those 1,000% winners. I can't tell you how many emails I've seen from other products and other people in this industry that are touting those types of returns. The problem with that, guys, is you've got to take into consideration that we're in a historic market. We've seen huge moves. That is not sustainable. It is not the new norm. It's great when it happens, and I'm not saying you shouldn't trade long calls, long puts. You should, but only as part of your portfolio. The credit spreads are the missing piece for so many people right now. Going forward, if we start to see markets chop, if we start to see them pull back, the credit spreads can be your best friend. They can allow you to make money even in a period of uncertainty. Now, everything that I've talked about today, all of these credit spreads, they are all risk-defined trades. If we're dead wrong, I know what my maximum loss is up front. They're very, very safe types of positions. All right. Now, on the overnight pop trades, they are part of our ETF Options Superstars program. And what I'm putting on the screen here is a link to a video that you can review over the weekend. It'll show you how the program works because you have the opportunity to piggyback off of our trades. We send out our trade recommendations to our customers every week. We send out between 3 and 5 recommendations each week. Those alerts will have all of the details of the trades that we're taking, the options that we're trading, the pricing that we're looking to get filled at. We alert you when we're getting into a trade. We also alert you when we're closing out of a position. That way you always know what to do from start to finish on every trade. I mentioned the overnight pop trades have had 26 winners and 3 losses in the last 30 trades. And that's just with the overnight pop trades. I mean, we're taking longer term positions as well. We're trying to diversify as much as we possibly can. So all you have to do is go to the link on the screen. It's netpicks.com/0121 EOS. And EOS stands for ETF Options Superstar. So we'd love to have you take a look at that video. We do have some specials going through the weekend, so you can get access to the program for a very great price point. Pretty excited about the program here for all the new members that have joined over the past week or two. So if you have any other questions that have popped up here today, if you'd like me to take a look at any other markets, feel free to type those in now before we wrap up for the week. I will jump back on midweek next week. We'll take a look on Wednesday, see where we stand on some of the trades that we talked through today, the plug power and the XLE trades. And then we'll also take a look at some new positions next week at that point as well. So again, keep in mind, markets are closed on Monday. Enjoy your long holiday weekend, everybody. If you're watching the recording, if you're watching the video, feel free to contact me anytime with the questions you might have there as well. Mike@netpicks.com is the email address. So I'm going to wrap it up here for the day. Enjoy your weekend.